Bill Ackman is a well-known investor for a reason. He has averaged a return of 16.9% each year since 2004, which is much better than the S&P 500's average return of 9.6% over the same period. During the pandemic, he turned $27 million into $2.6 billion thanks to his expertise, which helped him make billions during the 2008 recession. Ackman made billions on the last two market crashes, and he is now betting big on something he believes will return even more money. Despite his lack of popularity, Ackman's track record shows that all retail investors should listen to what he has to say. This video will delve into his new bet on one of the world's largest market crashes. But first, if this is your first visit to our Smart Stocks Academy channel, please accept my warmest greetings. Hit the like button, subscribe, and click the notification bell next to it to be the first to know when a new video like this is released. So if you're ready, let's get to the video. To obtain big returns, Bill Ackman employs two key tactics. The first is to use his clout to influence businesses in which he has invested, a practice known as activist investing. Ackman's second strategy is called short-term speculation, which is arguably more profitable. This video will concentrate on the second strategy. Bill Ackman is highly astute in how he bets on short-term moves because he is always on the lookout for asymmetric risk. Typically, investors feel that taking one or more risks equals a larger profit, but this is simply not the case. Ackman and other hedge fund managers want asymmetric risk, which means minimal risk and great gain. Ackman recently discovered a gamble with significant asymmetric risk. Despite the Fed's past claims that inflation is just temporary, everyone knows that inflation is continuing to rise. Consumer price growth has accelerated, rising from 1.2% in November of 2020 to 6.8% in November of 2021. And that is clearly a significant rise, and for good cause. With 0% interest and monetary stimulus when the Fed buys bonds, the Federal Reserve has been resolute about having to print trillions of dollars into the financial system. The stock market has risen sharply as a result of the Fed's efforts, but this will not remain indefinitely. Bill Ackman presented a presentation to the Federal Reserve in late October, stating why the Fed should begin tapering immediately. The imminent market meltdown that would eventually result from a few approaching causes was disclosed in Ackman's presentation. First and foremost, since the outbreak of the pandemic, the government has pumped $5.1 trillion into the economy as stimulus. $5.1 trillion is 25% of the US gross domestic products, which is unprecedented in terms of its repercussions. This level of expenditure by the Federal Reserve can be seen in this graph of the Fed's total assets. The Federal Reserve is continuing to buy bonds worth hundreds of billions of dollars, which is temporarily preserving the economy. Rather than solving future economic problems, these policies are postponing them. This is evident in Fed Chair Jerome Powell's response to inflation, which he expects to continue into next year. The stock market does not come crashing down out of nothing. There are usually events that build to the point where a market crisis occurs. The federal government's actions have left two possibilities, both of which have disastrous consequences. For the sake of the economy, the first step is to hike interest rates and quantitative easing. This, of course, would very likely cause the stock market to crash, but it would save the US dollar from further inflation. The second alternative is to hold interest rates at 0% and not taper, allowing inflation to accelerate. To put it in another way, the second alternative is to continue printing money. This option would be far worse than the first, since inflation would continue to ruin the economy while also destroying the US dollar. Bill Ackman advises the Feds to take the first option, which is to start tapering and hiking rates right away. In effect, the market has already collapsed. All the Fed has to do now is to choose the least worst scenario. We are going to dance while the music is playing, and it is time to turn down the music and settle down, according to Ackman. This was a reference to the film Margin Call, which depicted a possible scenario in which the economy might crash. The economy has been thriving, and Bill Ackman is continuing to dance as the Fed keeps interest rates at 0%. But it is time for the Feds to stop playing music and allow the economy to right itself. Ackman is hedging his portfolio with a short position in anticipation of this, and this was tweeted by Ackman. There are a few markets that investors might short to hedge their portfolios, but Ackman is shorting one in particular. The market I'm referring to is the bond market. Bond yields have fallen to historic lows as the bond market has risen dramatically over the last few decades. As some of you may know, rising bond prices lower bond rates, while falling bond prices raise bond yields. Because the two variables are inversely related, shorting the bond market is a wager that bond yields will rise. The yield on a 10-year US Treasury bond is currently at about 1.4%, which is much less than the rate of inflation. So, why would anyone buy bonds when inflation is almost surely going to be greater than 1.4%? It would be like putting your own money on fire if you invested in such a thing. Bonds are in the bubble, according to Ray Dalio, Cathie Wood, and Warren Buffett, and I'm sure many others agree. Because bond yields can't go much lower from here, shorting the bond market is an unbalanced gamble. Bond yields, on the other hand, may easily rise significantly to account for the rapidly rising inflation rate. This is Michael Burry's short trade, which I'm sure many of you are familiar with because of the film The Big Short. Burry said on Twitter, Burry is implying that he will enter the bond market, which he can do by shorting a bond ETF such as the TLT, iShares 20 plus year Treasury Bond ETF. However, Michael Burry, a high net worth investor, may be employing a more complex bond derivative that is not available to normal investors like you and me. Bill Ackman, for one, is doing just that. Ackman is investing in two types of derivatives: credit default swaps and put swaptions, which are bond swap options contracts. Interest rates are divided into two categories: floating interest rates, which fluctuate with the bond market, and fixed interest rates that remain constant regardless of market conditions. Swaptions are variants that are bought from the bond lender's perspective. Owners of swaptions must pay the interest rate to bondholders instead of receiving an interest rate for purchasing a bond. A put swaption is an agreement to overcome the bond lender and pay the bondholder a fixed interest rate. In the event that interest rates rise, the owner of the put options would profit from the interest rate differentials. The floating interest rate in this case increased to 4%, but the owner of the put swaptions has a contract to pay a fixed rate of 2%. As a result, the put swaption owner would profit from the 2% differential and interest rates. This difference would raise the value of the put swaption, allowing the swaption owner to generate large sums of money with a small investment. Ackman bought put swaptions because he stands to make a lot of money if interest rates rise. He does not lose a lot of money if interest rates fall or stay the same. Credit default swaps are another derivative that Bill Ackman bought. A credit default swap is equivalent to purchasing home insurance. The owner of a credit default swap must make a little payment on a regular basis. Let's say $500 per month for the sake of this example. A credit default swap protects the borrower's ability to make monthly payments by ensuring the borrower's capacity to pay. In the case that the bond defaults, the banks would be required to begin making monthly payments on the bond, which would be substantially greater than the current monthly payment of $500, for example. While this isn't an exact analogy, it is comparable to a house catching fire and the bank having to pay an amount as high as $500,000 to repair the house on a $500 monthly payment. Bill Ackman is employing put swaptions and credit default swaps to profit on bond market disasters worth billions of dollars. In the 2008 recession, Ackman successfully benefited on this. Now he is doing it again, but this time with put swaptions.
pre-financial crisis, we were concerned about what was going on in the credit markets. So we built a very large notional short position in credit by purchasing credit default swaps on the bond insurers, on Fannie Mae, Freddie Mac, on the banks. And as a result, S&P was down 52% in, I think, 2008. And I think our peak decline was 18%. It was just momentary. And we finished the year down only a few percent. And we were up 40% the next, driven by that hedging gain and the redeployment of those proceeds in buying stocks. And then last year, when we became quite concerned about the pandemic in February, we did the same thing. We thought the best way to express this concern and in a risk minimizing way is to, again, buy credit default swaps, put a very large notional position in the credit default swap market, and then spreads gap very widely as it became clear that this was going to be a pandemic. And then we reversed that position as our portfolio declined in value, our stocks went down, and our hedge became enormously valuable. So the hedge actually, on a mark-to-market basis, mitigated almost our entire mark-to-market loss. But more importantly, it gave us capital to invest, over $2 billion of capital to invest in a market that was down a large amount. And most recently, our biggest kind of black swan fear for the markets earlier this year, we became concerned about inflation. We thought inflation could lead to higher rates. We thought higher rates could lead to lower values in the equity markets. And we built, again, a very large notional position betting that rates would go higher. We did this using swaptions, which are sort of an option on an interest rate swap, which is a way to express that kind of bet. But the three things I mentioned they're small. The capital commitments are 1%, 1.5% of capital, numbers like this. But they can turn into very, very large numbers in the event that the sort of outlier event takes place.
I previously stated that the yearly rate of increase in consumer prices has gone up from 1.2 to 6.8%. But this is not always the case. I was referring to a rate that was based on the Consumer Price Index, or the CPI. The Consumer Price Index tracks a weighted basket of items to produce an average price for consumer goods. In theory, this is excellent. However, the index data gathering for house prices is very wrong. By relying on surveys, Ackman believes that the owner's equivalent rent, or OER, is understanding inflation. Using a more precise rent tracker, Ackman discovered that the yearly inflation rate should be 10.1% rather than 6.8%. This is what Ackman said on Twitter. It's certainly unusual for the OER to record a growth rate of only 3.5% for rent prices. This is obviously incorrect and should be corrected with the rent prices for a single family. Ackman went on to say more in a tweet. A 10-point percentage increase in inflation would be alarming to the bond market. Investors in bonded securities would get a net inflation-adjusted return of negative 8.7% per year. Some may argue that this inflation is only temporary, but Ackman disagrees. He wrote this on Twitter. As if things couldn't get any much worse, Congress' budgetary policy isn't helping matters. Joe Biden intends to enact an infrastructure bill under the Build Back Better measure that may be worth $2 to $3 trillion, or around 10 to 15% of the US economy. Inflation will almost definitely continue to rise in the future as a result of this. Other market worries mentioned by Bill Ackman were slowing Chinese economy, the introduction of new COVID variants, second-order supply chain consequences, geopolitical risk, and cybersecurity risks. These occurrences may have a negative impact on financial markets in the future, but only time will tell. Do you think Ackman's prognosis is correct? If you are, how are you putting together your portfolio? And with that, today's video comes to an end. If you haven't already, hit the like button below to show your love and support for this video. Also, don't forget to subscribe to the channel by clicking the subscribe button and turning on the notification bell next to it to be the first to know when a new video is posted. Thank you for taking the time to watch, and we hope you had a great time. We hope to see you again soon.